All right, welcome everybody to Live Valuation. I'm Midas Moriarty, and today we're going to be taking a look at ticker DHI, DR Horton Homes, home builder. We covered a little bit last year. I'm very interested and excited to update the valuation that we have in our spreadsheet for this home builder. It is, in fact, one of the largest home builders in the United States, the largest by total volumes for quite a long time, which we'll get into some of the specifics of that. Before we get into the valuation specifically, talking a little bit about the watch list that we have of all of our other valuations here. Normally on Mondays or Tuesdays, if there's a Monday holiday, as there was this week, I might normally have made some purchases on the Monday or Tuesday, as I typically do. I didn't actually make any purchases this week, however, not because I wasn't particularly intending to, but frankly, I was just a little too distracted with all of the holiday happenings going on. And so I didn't actually get my buy orders in before the market opened. So that just is what it is. But that's fine. I really would have just made some small purchases anyway, probably in like Smith & Wesson or something, since that's what I've been buying a lot of lately. But regardless of that, I'm still pretty excited to get into the valuation here today. Obviously, we are here a little bit late, a day later than normal. We normally do our valuations on Tuesday, but for the same reason, the holiday weekend kind of got a little bit away from me in terms of trying to keep my normal week going. So it took a little while for me to get back to my house after a little bit of some vacation time. But regardless, here we are today, ready to do the DHI valuation. As I said, we did one last year, and it was definitely overvalued at the time. I was doing a few other home builders at the time, but and I actually took a position in one of them, and then eventually exited that position as I decided that I didn't like some of the dynamics going on in the home building space. But I am still hoping to pay attention to the home building space. And with that, before we get into the actual valuation itself, we also had a little bit of economic data come out today that's actually kind of relevant to that. Today we had the pending home sales for the month-over-month number coming in today, and it was expected to be coming in at negative 0.8% for the consensus estimate for the pending home sales, but it actually came in at negative 4%, which if you kind of take that in line with what we're doing here today, focusing on home builder, that means obviously home sales came in a little bit cooler than expected. And the implication with that is that that would be the type of sign that the Federal Reserve is hoping to look for in terms of seeing a slackening in total demand, especially in something like the real estate sector. We also got some information yesterday that kind of runs a little bit contrary to that, however, with the new Case-Shiller home price index coming in yesterday. The year-over-year number was expected to be 8.2%, and it was actually 8.6% because the month-over-month number was not as large of a decline as was expected. So while demand has been softening, the actual prices haven't been coming down as much as expected. So it's a little bit of a mixed messaging going on with the economic data as far as like how that's going to affect the overall DR Horton valuation. So with that, we'll actually get straight into the actual valuation for DR Horton, starting with some of the company specific information that I like to cover at the start of every valuation. But before I get into that, I will say, please, if you're watching now, either live or on replay, please give the video a like. It's the number one way that you can pay me for the content that I'm providing here. If you enjoy the content I provide, please like the content. That way it attracts more viewers to the channel. And also, if you've already liked it, please go ahead and subscribe to the channel if you haven't already, and ring the notification bell as well. That way you get notified whenever I go live or whenever I release any other content like this. Also, if you've done both those things, there's also the link to the Discord that you can find in the description below, or it's the pinned comment in the chat. Joining the Discord and make you join our little group that we have going on here, where we like to post things related to daily news, actions going on in the markets, things that we're working on, ideas for our own portfolios or analysis for companies and things like that. So come be part of the community there in the Discord. So with DR Horton, they were founded in 1978. It is a somewhat of an owned operation with the major shareholder, the founding man, Mr. Horton himself. However, it is being currently led by David Auld, who was elected in 2014 to be the new CEO of DR Horton, passing on from Mr. Horton himself. He did join the company in 1988, so he has a pretty long-standing experience, not just with the home building space, but also with this specific company. In fact, this company in general has a pretty large amount of managing experience, which we'll get into when we get into the slide presentation. They are on the New York Stock Exchange, incorporated in the United States, and have their major websites listed here. As we already said, they're part of the home building industry. Obviously, the customers are pretty much just America in general. Top competitors, there's a pretty wide range of competitors that they have. Other home builders, Pulte Homes, Lennar, NVR, Toll Brothers. There's many others. I just listed a few of the major ones. And then top suppliers, well, there's a pretty wide array of companies that you can consider suppliers for them. I really just listed a couple here. Some lumber companies like UFPI, Boise Cascade, Weyerhaeuser, Interfor. Also, there's all the construction supply companies, not to mention construction servicing companies. There's a wide variety of companies that can be considered relevant suppliers for the home building space. I just listed a few there. The next expected reporting date is going to be the 24th of January. Also expecting to have the call there. However, there's also expected to be an annual general shareholder meeting on the 18th of January. So a little bit before the call, they can have that. Presumably, there would be a lot of information about their expectations for the following year there. Because as we'll get into in their slide presentation, they didn't really provide a whole lot of guidance for the short term due to the economic situation. I was getting into that specifically. They didn't really provide, like I said, a lot of guidance there. They said that their hope for revenues is that they hope to have a little bit more basically than last year, which is pretty vague. But they did say that on the lower end of their range of expectations for revenues, they expect maybe down mid-teens. So basically, I guess you could say that there's a range of expectations of anywhere from slightly up in terms of revenue to possibly down mid-teens is kind of the range of expectations that they have for 2023, according to the management themselves specifically. They also said that they're expecting 23% tax rate, so that's pretty relevant information for our building up of the discount rate. Also on Yahoo, the analysts, there's 13 analysts that find a revenue expectation of about 28.22 billion, and then the 13 analysts also expect 27.78 billion for the year after that, 2024. The adjusted EPS for 2023, according to 20 analysts, is $9.79 and $9.97, according to 18 analysts for 2024. We'll definitely be relying on both of these expectations, the expectations of the analysts, also the worst case expectations of the company themselves, but also the EPS expectations for the next year for our short-term assumptions of both revenue and margins, as I typically often do. I use my own projections for the longer-term assumptions, and I often rely on the analyst assumptions for more of a short-term estimate of what's going on. Their trailing 12-month dividend was 90 cents per share, which was recently up to $1 in total for the 4 quarters. That's 25 cents per quarter per share, which annualizes up to about 1.14% in terms of annualized dividend yield. They also have $438 million authorized for share repurchases, which equates to another 1.4%. So between the two, we have a total of a potential 2.57% in total shareholder yield, assuming they would use all of that within 1 year, of course, which there is no expectation or obligation to do so. Current holdings for insiders is about 12% or so. As I said, the original founding owner, Mr. Horton himself, is a major shareholder as would be expected there. So that's partially why we have such a large insider holding, which is always good to see. And also the insider holdings has increased by about 2% or so over the last 6 months. About 87% of the total float is held by institutions. So it is a pretty largely institutionally held company, which makes sense considering it's one of the largest home builders. Out of the total shares outstanding, about 4% is currently being shorted, which comparative to the overall float, considering there's a considerable amount of shares effectively off float, it actually comes out to be about 5.5% of the total float is shorted, which is a decent amount of a short base to have. Also with about a 4.5 short ratio, which means 4.5 days or so is about how long the shorts have in relative terms that would be needed for them to cover the short given the current average volumes. And given that the 3-month average volume is actually about 3 million shares versus the 10-day average volumes have been elevated up to 3.4 million or so. So you can see there has been a little bit of elevated volumes in the short term, recent future compared to the last few months, even though there is a relatively high percentage of shorting going on, which I would say the combination between those two statistical pieces of information would say this is, if you thought this was a good value at the current price, that this would actually be a good entry point given that statistical information. Though of course that's given it's being a good value, which spoiler alert, I don't actually find it to be a very good value, but we'll get to that shortly. So anyway, we will come over to their earnings presentation to cover a few of the slides that they have here to kind of give an overall idea of the operations of the company. Coming down here, they have their map of where their properties and building operations are throughout the country. They don't really show it in by like lines of the specific segments of their business, but it's worth noting here that they disaggregate their revenues by geographic region, which is going to be pretty relevant for how we build up our revenue projections for the company. So just I'm going to point it out basically here. Effectively speaking, the way that their segments are set up is that they have a northwest region, which effectively is like these three states. But then they have like a southwest region, which is down here, a south central region, a northern region, which kind of stretches a little bit into the northeast, so to speak, a more solid pure east region, and then also a southeast region. And so it's kind of important to understand which parts of the United States that includes and which parts of the United States they're not operating in when we talk about that, because if you just think about the region names, it would kind of imply the entire United States, but obviously you can see there are certain states that they don't operate in, like most of the actual Northeast. So when they talk about their north, which includes some of the eastern section, it's really just this like Midwest kind of section, and basically stuff like that. And then they also talk that we're obviously missing a lot of this kind of like central northern area right here. And then obviously they have like east, which doesn't mean like the whole eastern, it's really just this like solid middle section of the East Coast. But anyway, like I said, we're going to be talking about the different segments of their business by geographic region a lot here shortly. So I kind of wanted to get very specific on that information and make it clear exactly how that works. And in fact, I'm going to skip all the way down here to the bottom of their presentation where they get into a little bit more specific information on that. They show the geographic diversification by sections right here. And so you can see what I was talking about. Northwest includes Colorado, Oregon, Utah, and Washington. Southwest includes Arizona, California, Hawaii, Nevada, and New Mexico. South Central, Arkansas, Oklahoma, and Texas. Southeast, Alabama, Florida, Louisiana, Mississippi. East, Georgia, North Carolina, South Carolina, Tennessee. And then north is Delaware, Illinois, all those. I don't really want to read them all. All the states there. You can see the overall disbursement of the revenue by percentages here. Obviously, the largest chunks coming from the South Central as well as the Southeast. And then a decent amount in the east and then southwest. So being the weaker sections of their business being the northwest and the north. So you can kind of get an idea of which specific states are the weaker sections of their business versus the stronger sections of their business, which is going to be pretty relevant again for how we're going to be building up the projections for them. And also where their inventories are is pretty relevant to how we're going to be thinking about this as well. We're not going to get into the super specifics of it, but if you pay attention really closely to these percentages, a lot of the larger sections, the sections where they have the largest amount of their revenue, the largest amount of their actual business, they actually have relatively a smaller percentage of inventory. It's usually only different by like 1 or 2 percentage points, but that makes a big difference overall. And what it means is that the larger section of their business actually has more of their inventory under control relative to the weaker sections of their business that have less control over their inventories, which means that the weaker sections of their business are more likely to become weaker, whereas the stronger sections of their business are actually more likely to become stronger, is what that would indicate to me. So we will go ahead and skip further back up to kind of the top of this presentation and then come back down a little bit because I kind of just wanted to get that second slide there after I covered the map. But there's a few other specific things I kind of wanted to point out, not a whole lot of them. This chart right here is also going to be pretty relevant for how we're going to be thinking about projections for the future. This is the total US single family new home sales by year in thousands. So you can see up that it peaked up here in 2005 at like 1.2 million or so homes being sold in that particular year, and then it also kind of bottomed out at around like 250,000, 300,000 or something in this kind of range right here. So you can see that it has ebbed and flowed. Obviously, even in the most recent peaks in 2020, 2021, we never got anywhere close to the peaks that we saw in the housing boom and bust in 2007. Or so. But if you kind of like look over the longer term of this kind of like 30-year period or almost 30-year period, the average ends up being somewhere around 600. It's kind of worth noting that that's the actual average here. And I kind of wanted to point that out here because it's just like we're going to be thinking about like how many home closings do we potentially see in the future, given a certain set of dynamics, in particular the interest rate. Because I kind of wanted to point that out. Like I said, this is a 30-year period, approximately speaking. So if I come over here to the 10-year treasury interest rate, now this purple line up here is the 30-year average, the moving average of the interest rate. I just kind of wanted to like point that out, that the 30-year moving average of the 10-year treasury is 4.7%. We're currently at 3.88%. So, relative to the time frame in which all these home purchases going on, even though interest rates have increased a whole lot in the last year, they're actually not even above the average in which all of this home activity occurred. And yet we're down here. And again, the average homes being built during this time frame was about 600. So we're currently actually building more homes on average than we did during this entire time frame, even though the interest rate has been moving up. And that's because the interest rate is still actually a little bit lower than it typically historically has been throughout this entire time frame, because 30 years is a long period of time. Most people in the investing community have only been really around for like 10 years, or at least on YouTube, that's definitely particularly true. And so a lot of people have a very short-term mindset about like how interest rates work and like what's an average interest rate. It's like, well, if you go back 30 years and you look at a 30-year period, a much wider period of time over multiple cycles, you'll see that interest rates are actually even still not that high. And so effectively speaking, I would say that you could argue that there would be more home growth in the future, a lot more home sales. And that's kind of the point of me making this little pit stop in this discussion here. And then also, obviously, in the backdrop of this graph, I was focusing a lot on the home sales part of it, which is the bars. But there's this line that's going through the backdrop here, which shows their market share over this entire time. You can see that DHI has grown their market share precipitously through this entire time frame, coming up to about 12% of the total home sales on any given year, which is pretty impressive. So we'll definitely be somewhat relying on that as just a general calculation. For example, if we come over here and just kind of take a look at it, as I had said, the average interest rate is like 4.73% versus the current interest rate is 3.88%. If you just take the ratio of that 3.88 as a percentage of 4.7, what was that, 4.74? I can't remember, 4.73. You just take the ratio of that is a ratio of 0.82. 0.82, again, we said an average of 600,000 homes being sold per year. If you increase it by a ratio of 0.82, which basically means that because of the fact the interest rate is lower than the average interest rate, we would expect there to be more homes being built. That means you would expect, given the interest rate, to have 731,000 homes being built per year. And again, about 12% market share. That means you might be able to expect about 87,000 worth of homes for Darden to be able to produce in a year, given the interest rate at its current level. That's not given necessarily specific demand, that's just given an interest rate, which we'll get around to that in a moment here. So a few other things I kind of wanted to point out before I moved on to the actual numbers for Horton itself. Like I said, this little calculation here will be more relevant when we get to the actual projections of the company. Obviously, you can see their market share that they've grown, as we just talked about. They've grown it pretty dramatically throughout. Top 5 markets: Dallas, Fort Worth, Houston, Atlanta, Phoenix, and Austin. You can see that their general market share is pretty dramatically higher than a lot of their main competitors in most of these areas. Pretty even in Phoenix, but for the rest of those major markets, they have much more market share than the next competitor. And then obviously across the various markets that they operate in, they are pretty much always in the top group of the markets they operate in for the vast majority of them. Top 10 out of 44 out of 45 markets that they operate in, which is pretty awesome. As I was just talking about, it's not just their CEO and their director that has a massive amount of experience. The whole executive team has on average about 29 years of experience, 20 years of experience for regional presidents, 14 years of experience for divisional presidents, even 10 years of experience for city managers. So yeah, tons of real estate experience, lots of people that understand the cycle, which means I think that they understand inventories relative to the cycle, and they understand how to clear those inventories out, which I think explains part of how we have such a good management of the inventories and the backlogs in the sections of the business where they're actually having a good amount of business, as we saw by the geographic disbursement of their revenue. And also they have a pretty good distribution of offerings across the different brands that they offer. They do obviously have a separate umbrella of brands. It's not just Horton Homes, which is the main brand that they operate. They also have America's Builder, Express Homes, Emerald Homes, and Freedom Homes, all those being different brand names that they operate under that offer a slightly different clientele, a different price range. So they can get this pretty good distribution of price ranges across the homes that they build. So that's going to be all the information from the presentation that I'm going to cover. So we'll go ahead and get into the actual valuation itself. As we typically often do, we'll start with the segmentation and the discount rate. As we kind of already talked about, they are a home building company, so that's the industry that I'm aligning them with. If we come over to my industry data set, we can take a look at the home building industry over here. And the adjusted unlevered beta for home building I have is 1.16. So that's the adjusted unlevered beta that I'm assigning Horton specifically. Also, we can take a look and see that the gross margins over a 5-year period has been about 21 to 22%. That's going to be kind of relevant to think about their position, relatively speaking. And a longer term adjusted net margin over an 8-year period is on average been about 8%. So that's also going to be pretty relevant to think about. And then in the more recent average of their sales to capital ratio is 1.48. So that's also going to be relevant information for us. If we come over here, I put that information into here, the adjusted unlevered beta. They operate entirely in the United States, so we don't need to adjust the equity risk premium for that. And then they have approximately 20% debt to equity ratio based off of the $6 billion in total debt that they have, at a weighted average interest rate of about 3.73% and a weighted average maturity of about 3 years. Now, this is worth noting, there's a little bit of a caveat with their debt here, which is to say that about 1.6 billion of the $6 billion in debt that they have is technically unsecured loans that are not guaranteed by Horton specifically, but and are operated within the financial service branch of their operations, which means technically speaking, it's debt that they could theoretically not have to pay, but it would maybe have implications for the future operations of their business. So I'm effectively going to treat it still as debt, but I'm pointing that out just because some people would argue with counting that as debt. But I'm going to count it as debt because I think it's the more conservative thing to do. Again, that brings their debt to equity ratio up to about 20%, which brings their levered beta up to 1.34. And then that brings their cost of equity up to 1.48 or 11.48%. 11.48%, pretty solid equity risk premium. The weighted average cost of capital we end up with is about 10%, which is a pretty decent cost of capital. That's double digits in cost of capital terms is usually a decently large cost of capital. Whether or not they can make the returns of the capital is also the big question. So we will come over here to take a look at their 10-year history. I have their financial history from 2013 up through 2022, as we have right here, going from $6.2 billion in sales up to $33.4 billion in sales in 2022, which is just dramatic growth. Look at that. It's like 5xing your revenues in a 10-year time frame is just insane, no matter how you look at it. So we can take a look at the gross margins. We can see that for the first 5-year period, they had average gross margins of about 20%, 21% or so, which you may, if you remember that the 8-year average gross, or it wasn't 8 years, it was 5-year average gross margins that we have for their industry was about 21%. Now, if we come and take a look at the most recent 5 years of their gross margins actually grew to 24%. So 24% versus about 21% shows that they actually do have a relatively competitive edge in terms of pricing on their cost of revenues for their business, so to speak. In fact, they ended with a high gross margin of about 30%, 26% in the year prior to that. So you can see high gross margins in the short term. In fact, if we come over to the data set, we take a look at the gross margins even in the most recent year to get a look at that. We can see that even so, the industry had gross margins about 24 to 25%. So even then, in the most recent year, they had 30% versus that. So pretty consistently, at least 2 to 3% higher gross margins than the industry on an average, if not maybe 4 or 5%. So if we come down here, we can also take a look at the adjusted net margins that they've had. We can see that there's a pretty large shakeup in the gross margins over time. For the first 5-year period of their history, we have gross margins averaging about 7%, versus for the next 5-year period, we have gross margins averaging about 12.5%, with the most recent gross margins being about 17.5%. So a huge growth in the gross margins as housing has obviously exploded in the last couple of years. The real question is where profitability is going to go in the long term. If we take a look at their average margins prior to COVID, so 2019 and before, the average margin is about 7.7%. So that's kind of worth noting. I'm definitely going to be relying on that as kind of like a baseline of where I think my margins will go for them in the future, 7.7%. And then again, that's comparing them to the average net margin over an 8-year time frame that we had was about an 8%. And the same 8-year period on a comparable basis for them was about 10.5%. So they still had even better margins on a net margin basis compared to their industrial expectation as well. Coming down to the cash flows, we can take a look at like what they've been reinvesting in total terms to get the growth of their business as a whole. Now, when I look at my adjusted net capex number, as I often talk about, this is a combination of not just capital expenditures, but capital expenditures plus depreciation, plus any amount of cash spent on acquisitions, as well as any change in net working capital. Now, it's important that we bring up the net working capital part because that is a huge portion of the investment for DHI. In fact, it's the majority of the investment that they do is in the working capital. And the reason why is because the homes that they build end up on their inventories. And so inventories is effectively the biggest portion of their capital. So we can see that here, looking at on this space, the overall amount of change in working capitals for the entire 10-year time frame is 1.6 billion per year. 1.6 billion in change in working capital per year is what they experience over the 10-year time frame. But anyway, if we take the whole adjusted net capex number, which takes all those things and then nets it out with depreciation, as I talked about, we can see that the average adjusted net capex for the first 5-year period was about 961 million per year, versus the next 5-year period it averaged 2.6 billion per year. So they've massively increased their reinvestment over the last 5 years compared to the 5 years prior to that. And obviously in the most recent year it was 5.8 billion, which is just an insane outlier. And again, the vast majority of that being inventory buildups, which, that's, a bit of a meme on this channel of something to be concerned about, but we'll definitely get into the complicated dynamics of their inventories in terms of like where those inventories are. As we were just talking about, their business is entirely very, very geographic sensitive. That's a very, very key element, is making sure that we take a look at where everything is, because real estate, it's all location, 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 as the famous saying goes. So anyway, if we take a look, if we take their earnings and we net out the adjusted net capex, and then we also adjust for the amount of debt that they took on or paid back over any given time frame, we end up with our free cash flows at equity, which for the first 5-year period averaged negative 22 million per year. So pretty close to zero, but still technically negative, a loss of money. And that comes off of the back of also having taken on about $204 million per year. So not only did they have negative cash flows, but they were also taking on debt and still having negative cash flows, which means they would have had an even more negative free cash flow number prior to taking on the debt. For the next 5-year period, however, they end up with about $1 billion free cash flow to equity per year that they have, which is the cash flows that they have available to pay out to their shareholders. Though it is worth noting that that does come off the back of about $624 million in debt issued per year for that 5-year period as well. But at least that means that even if they hadn't issued the debt during that time frame, at least they would have still had about 400 million per year before the debt issuance. But either way, they were still issuing approximately $400 million in debt per year for the last 10 years, which obviously means about $4 billion or so. So if we come down and take a look at that, obviously, like we were just saying, that means they did in fact have some cash flows that they could pay out to their shareholders. If we look over the entire 10-year time frame, it ends up averaging about 532 million per year that they could have paid out, and then the amount that they did pay out to the shareholders was 444 million. So not overpaying the shareholders over a 10-year time frame. Over the last 5 years, it was 832 million that they did pay out versus about 1 billion or so they could pay out, again, including the debt issuance. So I would say that even though they definitely had to issue debt in order to make their operations kind of work the way they did here, they still have been managing their cash flows effectively and not overpaying the shareholders, according to the way in which I like to read it. So if we come down here to also take a look at how their cash flows have turned into returns for them, the returns on invested capital that we have for the first 5-year period, they had returns on invested capital of about 8.5%, which is, not very impressive returns on invested capital. You definitely like to get it up in the double digits at least, especially as we kind of just talked about. Their current cost of capital is about 10%. That doesn't say what their cost of capital was 5 years ago, but currently about 10%. So you definitely want to get double digits if that's your cost of capital. But the returns on invested capital for the last 5-year period did grow pretty dramatically, up to about 18.5%, which again, if you compare that to maybe the 10% cost of capital that they currently have. But especially since, like I said, that's the current cost of capital, you can compare it to the most recent return on invested capital, where they ended most recently with 24 to 25%. Now, a huge factor, I think, driving this dramatic growth in returns on invested capital is obviously the huge growth in the business. As we talked about, they 5x their revenue. So the fact that they managed to 4x their returns on invested capital shouldn't be too surprising, I guess. But that does mean that they did have to leverage the overall cost to achieve it. So it's very solid growth of revenues. And then not to mention there's significant share repurchases that are driving up a portion of that, especially in the last couple of years in particular. So if we come down to take a look at the balance sheet, take a look at the overall assets they have, and we can get an idea of how that makes up the overall potential for growth of the business. Taking a look at the cash that they have on hand for the first 5-year period, in typical, they had about $1 billion on average of cash on hand, versus in the last 5 years, it's been more like $2.2 billion of cash on hand. And then most recently they end with about $2.4 billion of cash on hand. So definitely growing the overall levels of cash that they hold on hand with their business as their overall business grows. As we said already, about 5x in total growth of revenues. Definitely not a 5x in total amount of cash on hand, but over a doubling. So in total, in terms of relative amounts of cash on hand, you could actually argue that they don't have that much cash on hand, which is, in other terms, you could say that's capital being put to work. So also we have the accounts receivables. Accounts receivables have in fact 5x, as we can see here. Over the 5-year period, there was for the first 5 years, it was averaged about 681 million of accounts receivables, versus the last 5 years is average of 1.8 billion, ending at 2.8 billion. And if we compare that to the payables, we can see that in general they had 500 million of payables for the first 5-year period, so they were well covered at that point. And then in the last 5 years, it's been about $1 billion or so. So while the payables have also grown pretty dramatically, they themselves have 5x over the 10-year time frame. As we had already seen, the receivables themselves had also done a pretty good job of growing as well. So the payables are well covered by the receivables. Now, as I was kind of talking about with the cash flows, the biggest aspect of both their cash flow statement and also their balance sheet is going to be inventories, because that's where, in fact, they leave the homes that they build that are in their inventories and haven't been sold fully yet. As you can see, they had about 6.2 billion in total inventories at the start of the 10-year period, and then that grew up to 9.2 billion by the end of that 5-year period, and averaged about 7.8 billion. And then it's grown even more since then, up to 21.6 billion in the most recent year period. On average, for the last 5 years, they had inventories about 14.4 billion. So yeah, dramatic growth of inventories pretty much year in and year out, ending at $21.6 billion in total inventories. And comparing that to the total amounts of their assets, you can see that that's 2/3 of their assets. 2/3 of their assets is inventories. But again, it's a slightly different type of inventory because it's the house building inventory. And it's also worth noting, this is something you have to keep in mind whenever you're looking at any real estate balance sheet, is that these inventories are not listing it at market value, effectively speaking. It's like there's a pretty limited amount of flow through of actual market value costs because of the way accounting is done. So there, in some senses, you could say that this inventory is worth significantly more, but that also leaves it at a certain precariousness because obviously that value can drop as well. So if we take a look at the total amount of current assets, obviously with the inventories being the biggest component of that, for the first 5-year period, they had 9.8 billion in current assets on hand, versus the last 5-year period being 19.6 billion or so, ending at 29.4 billion. So huge amounts of current assets. Comparing that to the current liabilities, 5.6 billion in the most recent year period. In fact, comparing that to the total liabilities of 10.5 billion. So even just netting out all the liabilities from the current assets, we still end up with a dramatic amount of assets left over that ending up being, what is that, $18.9 billion in net current value, so to speak. And then obviously you can compare that to the market cap, the current market cap being less than double of that. So obviously it's not cheaper than the current assets versus value, but in terms of price to book on current assets, it's extremely cheap. Partially though, again, because most of that value is in the inventories. So if we come down, we can also take a look at their shareholder equity, which has grown pretty dramatically as their overall revenues. In fact, more so, which is what we like to see. Their overall equity going from 4 billion at the start of the 10-year time frame up to 19.4 billion or so at the end of the most recent year. So huge growth in total equity. That is in fact a 5x, which is pretty much in line with the growth of the revenues. However, even better than that, we have 2.1 billion being the retained earnings that they had at the start of the 10-year time frame, and that's exploded up to 19.1 billion. So that's more like a 9x. So even better. That's what we like to see. Retained earnings getting a strong leveraging out of the total growth of the overall revenues. So we come down from the financial statements, take a look at the sales capital ratio. You see the sales capital ratio shifting over time throughout the entire time frame. For the first 5-year period, their average sales capital ratio was 1.21. That means $1.21 in revenue for each dollar of capital that they have in the business, which is pretty good in general. As we talk about on this channel, there's a bit of an ebb and flow between net margins and sales of capital, because the net margins is what you get to keep from your sales, and the sales of capital is a ratio of the amount of money you had to put in to get the sales. So between the two, you're kind of getting your overall cash flow profitability from the overall investment. And typically speaking, if there's a low net margin, there's gonna be a high sales capital ratio. A low sales capital ratio, there's gonna be a high net margin, or vice versa, some combination between the two. So we typically, with a relatively high sales capital ratio, well above 1, as we see here, you'll typically see relatively low net margins. And as we kind of already talked about, the average net margins for Horton was typically pretty solid, but still single digits prior to COVID, and then they had exploded into double digits since then. So that's another reason why you can definitely see why it's more likely the margins will come back down to single digits, because we have such a strong capital efficiency, which means that their costs are being placed elsewhere, effectively in the costs of revenue in this particular industry. So for the last 5 years, they had a sales capital ratio of 1.48. So again, that's $1.48 in sales for each dollar of capital invested in business, ending at $1.43. So very, very strong sales capital ratio, which has in fact only gotten better over the 10-year time frame. And again, that's strong even relative to their industrial expectation, which the industrial expectation, oh, actually, never mind, my bad. I forgot, they were actually a little bit weaker than their industrial expectation. The industrial expectation for the last 3 years was on 148, whereas for them, the industrial expectation is currently 143. Though for the 3-year average, they actually is pretty much 148. It's pretty much directly in line with their industrial expectation. So with that, that's all the financial history that we were going to cover before we get into the projections for the business itself, which is definitely where the meat and potatoes of this stream is going to be. It's definitely a lot of information I have to show you here for the projections for Horton. I will ask one more time before I get into all this. If you're watching now live or on the replay, please give us a like. It is the best way you can pay me for the content that I'm providing here. And if you have already or haven't already, please subscribe to the channel. That way you get notified whenever I go live. And also, if you have done both of those things, there's also the pinned comment in the chat, and the link in the description below is the link to the Discord. Come and join the Discord, be part of our discussions that we have there about markets, portfolios, investors, all sorts of things like that. So come be part of the discussion there. All right, so getting into the actual revenue segmentation of Horton and how I'm going to project my revenues for them for the business. As we kind of already talked about, they segment their revenues by geography, and so what I've done here is I've taken their whole business, which I have in this little box up here, and then I've separated it off into the different segments of their business. They have the Northwest business, the Southwest business, the South Central business, the Southeast business, the East business, and the North business, which, as you see, that is a lot of information. So that's why I was like, oh boy, get ready to go through some of this. And now I did something to try to make it a little bit easier for people to look at, because obviously this is a whole lot of spreadsheet to look at. I did in fact make some graphs of this information right here. Now, all of these little segments have the same information. We have revenue, we have net homes sold, average price of the homes sold, the builder inventories, and the backlog for all of these different segments, which I have right here. And all the colors are going to be the same and in the same lineup, so it should be relatively easy to see. So you can see the blue being the Northwest, the red being Southwest, the yellow being South Central, the green being Southeast, the orange being the East, and then the blue being North. So you can get an idea of the overall revenues of these different segments. You can see that even prior to COVID, the strongest sections of the business were the Southeast, the South Central, and the Northwest portions of the business. And then after COVID happened, there was a huge explosion in the South Central portions of the business, as well as the Southeast portions of their business. While the Northwest didn't quite have the same reaction, there was a little bit of a explosion in 2020, and then 2021 had a large dip as far as that particular section, the Northwest section of the country, whereas the East had a pretty large continual growth throughout the entire time frame. In fact, considering the growth you see in the East growth rates prior to 2020, you could even argue that this isn't even necessarily that much of an explosion of growth in 2020, 2021, and 2022. It's a little bit faster, but not necessarily that much faster. It was already on a pretty strong slope upward. And the same can kind of be said for the North, which is the light blue here, kind of heading in the background. Whereas the Southwest, you can see there's a much more obvious precipitous climb in 2020, 21, and 2022. In fact, it almost parallels the downward movement in 2021 and 2022 for the Northwest. Now that's total revenues, which again, this multiple metrics we have to look at here. Something that I'm gonna skip up here to the total of all of the segments, which I have all 5 of those metrics for all 5 for the whole business right here. Now, one thing I kind of wanted to point out is the relationship between these metrics. Now, if you take the revenue and you see the correlation between the home sold and revenue, you can see that there's actually a 45% correlation between home sold and revenue of the entire business, with a 20% explanatory power. There's also a 64% correlation between the price change and the revenue, with a 41% explanatory power, which basically means, and these are the 2 most effective things on revenue, which basically means that revenues can mostly be explained by the total amount of homes sold and the price change, which should be obvious. That should just be common sense. The total amount of homes that you sell multiplied by the price you sold them at is going to be the revenue that you're going to have for your company. That should just be obvious. Now, the interesting part is that if you take the homes sold and correlate them to the price change, which are the 2 factors that drive the revenue. So if you correlate those 2 factors against each other, you actually find out that they are negatively correlated against each other. Now, why would that make sense? Think about it. The more a price goes up, the less homes are going to be able to be sold because the price is higher. and vice versa. If the price goes down, more homes are going to be able to be sold. So while more homes being sold and prices being higher, both of those being up lead to more revenues, each of those things are negatively affected towards each other because of the fact that high prices means less people can purchase homes and low prices means more people can purchase homes. And there is actually strong explanatory power to that negative correlation, because that also makes perfect sense. So I'm pointing this factor out because that's important to know before we come down to the segmentation by different geographies again, because I do have here the net sold homes and the average price, which, as we just discussed, should be the two factors that would explain revenues the most. So if we take a look at net homes sold, and we see we can take a look at the overall trend between them, we can see that there is pretty strong growth prior to 2020, prior to COVID. We can see that the Southwest or the Southeast and the South Central were both having a pretty consistent slope upward in terms of total growth, as was the Northwest and the East. However, we can see that after 2020 began, there is a little bit more of a complicated mix up between the two. And then also, if we switch over to the average price, you can see that most of the regions were actually having relatively stagnant price growth prior to 2020. Even the Northwest, or I would say even the South Central and the Southeast, which are seemingly the strong portions of the business in terms of net homes sold, didn't necessarily have that strong of average price movement prior to 2020. So overall, even though the average prices have a huge factor on the overall revenues, prior to 2020, that wasn't necessarily a huge factor because there wasn't that much movement in the prices, which gets us back to the discussion that we were having before about the interest rates. Because again, interest rates have been moving up. Interest rates moving up means home prices are going to be coming down. And if home prices are going to be coming down, that means that there theoretically is going to be more homes sold. Now, this gets back to something I had said earlier about from their earnings deck about the total amount of homes sold in the United States. Right here, we had done a brief little calculation based off of the ratio of the current interest rate to the average interest rate over a 30-year period versus the total amount of homes sold here and the current market share of DHI. We said that there should be about 87,000 total homes sold by DHI according to the current interest rate. Now, if we take a look at the total amount of homes sold by DHI in the most recent year, you'd see that was actually 76,000, which means that based off just the interest rate alone, you could argue that there should be more homes sold, and that the only thing that is preventing those homes from being sold is the fact that these prices bumped up so dramatically in such a short period of time. But again, interest rates are coming up, which means prices are going to come down. So the point is, all this should argue for home prices coming down should actually cause many more homes to be sold. There's been a lot of concern about the fact that the mortgage market is drying up, but there's also a general lack of home building, a backlog of homes that were not built since the crash in 2008. So I would argue that there's actually a decent amount of room left for homes to be built in the next 5 years. It just comes down to where those homes are going to be built, which again gets down to these different sections of where their operations are. So which gets us to these last two graphs, which I haven't talked to you about at all, which is inventory and backlog. So obviously that's going to matter a lot about where prices are going to go. And you can see here that the places with the largest amount of inventory are South Central and Southeast. South Central and Southeast, if you look at what the average prices are, they're actually at the bottom rung of where the average prices are. So if high inventories is supposed to lead to lower prices, because that means that there's too much supply on the market, then that means that those lower prices are going to lead to more demand. And then again, if you take a look, the places where the high inventory is also the places with the high amount of net sold. So I would argue that South Central and Southeast are probably going to continue to explode in terms of net total homes sold based off of this metric here. And then if you take into account the backlog as well, the backlog has also exploded in those two specific areas, which shows that yes, there is a decent amount of homes and revenues that could be backtracked if the pricing changes too dramatically. But I think that also shows that there's a decent amount of demand in those areas. And the fact that the prices are cheap, I think is part of the reason, relatively speaking, they're relatively cheap, I think is part of the reason that demand is there. So anyway, it's a lot of kind of top down talking about the different geographic disbursement of where they have the revenues, net sold homes, and average prices and all that. Now, getting into, again, the actual data specifically, we're gonna have to talk a little bit more about each section individually. What I did here is I kind of just took into account multiple factors about what I think is going to happen here. How I'm building this projection for the revenues is I didn't want to make assumptions about where I thought real estate prices were going to go. So instead of making individual assumptions about how fast I think home prices are going to grow, I decided I was just going to rely on one constant growth rate, which I'm going to use the 10-year treasury rate, which is 3.8% or so right now. And I'm going to assume, what if all home prices just grew at the 10-year treasury rate for the next 5 years at about 4% per year? That's what I did here. I basically took the average price in 2022 and I multiplied it by the 10-year treasury times 5 up to get to a future price for each of those areas. And again, I used the same growth rate for each geographic segment. Now, you might say, well, that doesn't make sense. Why are you using that growth rate? Again, let's wait for it here. The point isn't the price. The point is the revenue, and the revenue is going to be price times homes sold. So what I'm doing is I'm just going to assume that that's the growth rate of the homes, and then based off of that growth rate and based off of the different dynamics of the stuff that I've talked about here, I'm going to make an assumption about how many more or less homes I think will be sold if that is the price. So I'm taking the price as given, and then I'm just affecting the demand based off of the price. So if in the Northwest, the price of homes in 5 years is 687,000, then I would expect maybe more or less homes relative to the most recent amount of homes sold. And then I can make an assumption of revenue based off of that. Now, taking a look at this, I take a look and I find that the correlation of homes sold to price is solidly negative for the Northwest, which is what I would expect, but it is a negative downward movement in terms of expected amount of homes to be had. And then I would also take a look at the average price change over the longer term time frame and compare that to the price change that I'm talking about. The average price change for them over 3-year periods has been about 2.5%, and I'm talking about a 3.8% price change, which is a higher rate of growth. A higher rate of growth means less homes being sold, which is a negative affectant, which is why this is red. So negative means red, positive means green, and I'm basically just adding up the different factors too. So 2 negative and 2 green here equals positive 0, which means they're going to have exactly the same amount of homes that they sold previously. It's a pretty rough estimate that I'm doing here. And now these positive ones on here might be like, well, what's going on with that? What I'm doing here is I'm taking a look at how much has the inventory grown relative to its average growth. If it's grown less in the last 3 years comparative to its average growth, then I consider that a positive. If it's grown its inventories more than it has in the last on average over the longer term, then I consider it a negative. Same thing for the backlog. If the backlog has shrunk or has grown less than it typically has, then I consider that a positive. If it grows more than it typically has, I consider that a negative. So for Northwest, we end up with net 0, which means an 100% factor, which gets me about $3 billion in revenue. For the Southwest, based off of a home price of 630,000, I end up with 3 positive and 2 negative, which gives me a positive 1, which would give me a factor of 125%. And then I decided to give them an extra 25%, partially because the Southwest was one of those 2 regions that's just done so well. And I frankly just think they're going to do a lot better. So I gave them an extra 25%, which makes their total revenues come up to 7.67 billion. And then if I come down to South Central, this one has 2 negative and 2 positive. And then that also I give an extra 25% because South Central was one of the other segments that is also doing really well. So I decided to give them a little bit of an extra boost to that, which gives them a factor of 125%, which gives them revenue of 11.1 billion for South Central. Then Southeast, based off of a price of $456,000 per home, they have 2 negative factors and 1 positive factor, which gives them an overall multiplier of 75%, which means that they would have less homes sold than they had in the most recent year in 5 years. And that gets me 7.4 billion. For East, we have 2 positive factors and 2 negative factors, which nets them out at 0, which means that the multiplier stays at 100%. And based off of the home price of $453,000, that would get me a revenue of 6.1 billion for the East. For the North, the last of our segments using this methodology, I have 4 negative factors, so not a very good region to be in. Based off a price of $503,000, Now 4 would theoretically bring the multiplier to 0, but I can't actually have a multiplier of 0 because of just the simplistic method I chose to use here. So I gave them an extra 25%, partially because I kind of had to with that methodology right there. But also there is some reason behind it, which is that if you actually take a look at the North, they actually have some of the lowest overall backlog comparative to the inventories and amounts sold, which actually gave me some reason to believe that even though they have a lot of negative things going on, there's some reason that they could actually do better in relative to my expectations in the future. So either way, a multiplier of 25%, and that gets me revenues of 878 million. So if I add up all those individual segments of revenues, that gets me to a total revenue for the company of 36.357 billion in 2027, which if you compare that to the most recent year revenue, that would equates to 3.7% of sales growth per year for the next 5 years. So that's my my projections for DHI. As I said, a bit complicated, a whole lot of information that we kind of had to get through to look at, but I thought it was pretty worthwhile to do. It's like I looking at the home builders, they have all their things separated by location. It's the thing about real estate is it's always been very geographically sensitive, and so I was just like, you know what, I think I'll just go to the effort of breaking it down by all 6 of these different segments and doing it that way. And I think it was worth it in the end. So that's going to be our projections for the revenues of DHI is 36.5 billion or so. Coming over here to our actual projections, I am going to be relying on the 3-year average as my base year in order to simulate an approximate 13% decline in the short term, and that fits with the company's expectations of their low range of estimates for the revenue of the next year of being down mid-teens. That was their estimate of the low range of their estimate. So I am being a little bit conservative here, but let's be honest. Let's be conservative when it comes to a home building valuation. So with that, that's going to be my estimate sort of for the short term. And then in the long term, we have it growing from there at 0% in the worst case scenario to 12% in the best case scenario. On expected basis, we get it to about 2.5%, which gets us to expected revenue of 37.6 billion. Now you might be like saying, oh, well, that's approximately the revenue number you had here, give or take a few hundred million, but this percentage is so much different. Why is it 3.7 there? Why is it 2.5 here? Part of the reason is because the total revenues from the home building here is actually not exactly their total revenues. If you'll notice here, there's actually 2 lines at the top here of total revenues. So, and that has to do with the financial servicing parts of their business as well as the rental portion of the business, but they're almost exactly the same. If you look at this, the average revenue for the 10-year time frame of the home building was 16.5 billion, and the average revenue of the total company was 16.6 billion. So it's like almost the same, give or take. So really, I just ignored those small, tiny other sections of their business and just focused entirely on the home building portion of their business. So with that, that's going to be my revenue assumptions, which gets us to an expected revenue of 37.6 billion, which is a little bit higher than our assumptions we have here. But I'm going to call that a little bit extra, the financial services extra portion. That's good enough for me. And then coming down here to, and it's also worth noting that I did already alter the probability distribution to put 25% in the more optimistic model versus 15% in the more pessimistic model. We're definitely weighting a little bit more towards the optimistic side, not because I'm super optimistic on the business, but because I just wanted to include a decent amount of negative potential here, but not necessarily weight them a lot. So I still wanted to have it more weighted towards the better outcomes. Either way, like I said, we were kind of trying to work backwards to our expected revenue here based off of our projection that we built up from here. But anyway, so yeah, that's the probability distribution that we're using. They had also guided for us that they expected 23% tax rate, so we went ahead and just used the 3% average here, which gets us 23%. Easy enough. Now for the margins, I'm relying on the 5-year average in order to get to a base of about 12.5%. The only reason I'm choosing this as my base is because it makes my expected net income of next year and the EPS approximately $9.50 of EPS, which is approximately what the analysts were expecting for EPS next year. So that's just, like I said, I'd like to rely on the analysts for short-term assumptions and then rely on my own projections for long-term assumptions. I find that to be a pretty simple way to go about those types of assumptions. So I'm relying on that. Effectively, we're assuming that their margins are going to be cut by more than a third within 1 year, and then it's going to trail downward from there towards the longer term average, which for us, we have on an expected basis about 8.3%. It's on a range from 2 to 13%, stretching towards 9, which gets us to the 8.3%. The reason I chose this kind of range is partially because, as I kind of already mentioned, The average margin that they had prior to COVID was 7.7%. So it's about in that range right there. Not to mention, we also had looked at the data set for their industry, which gave us a longer term 8-year average of margins of about 8%. And then we had also found that on a gross margin basis, as well as net margin basis, and they were typically a little bit more, they had typically had better profitability than their competitors. So maybe giving them a little bit of a tiny extra boost there. So I ended up at about 8.3%. You could easily adjust these assumptions around a little bit. You could easily maybe raise the lower bar up a tiny bit, or raise the upper bar up a tiny bit. You could easily change my assumption about the short-term EPS around a little bit. There's a lot of little changes to the margins that you could alter here that would be just as fair, in my opinion. There's nothing magical about the assumptions I made here. We're just assuming that they're going to return to their longer-term average, effectively speaking. In terms of the sales capital ratio, as we had kind of seen, the sales capital ratio is currently about $1.43 or so in sales for each dollar of capital invested in the business. We're assuming it'll trail down a little bit, down to $1.37 maybe, and that has to do with probably a significant decline in revenue in the short term, and then it'll come back up, but their capital will probably have to be adjusted as well, effectively speaking. But either way, we expect them to kind of remain in that range. Again, their industrial expectation being about $1.48 or so currently. We have a range of anywhere from 0.75 to 1.5, stretching towards 1.25. That gets us an expected ratio of 1.37, given the expected sales that we currently have already implied. So with that, we also have a debt to equity ratio. The current debt to equity ratio is about 20%. I have a range of anywhere from 10 to 60%, and having it stretched towards 30, which gets us to an expected basis about 33%, which is significantly higher than the current debt to equity ratio. And that partially has to do with the fact that I think that they will have to take on some more debt in the short term, which is where things get a little bit more complicated, because this is a bit of an assumption I'm making here. Partially, it comes from the market cap adjustment. If they come back down to fair value, that means their debt to equity ratio will go up, because I'm using market value weights. But also, we already talked about this a little bit, they do have a significant amount of debt here, which is at a pretty good interest rate for a lot of it. However, there's a decent amount of it that does have to be rolled over on a relatively short-term basis. A decent amount of it that will have to be rolled over within the next couple of years, and then that's going to be pretty sensitive to whatever interest rate they're going to get at that point. And so, effectively speaking, I'm assuming that they might have to take on a bit more debt to deal with that situation. This is another thing that you could maybe easily adjust small amounts of the value to it, but that doesn't necessarily have a huge effect on the overall valuation necessarily. As you can see here, that changed it by like pennies, so it doesn't necessarily have a huge effect. So with that, that's all the assumptions that goes into our valuation, and we can call it and come over to our summary page. I'll ask one more time for anybody watching now live or on the replay, please give us a like. It's the #1 way that you can pay me for the content that I am providing here. And also, if you haven't already, please subscribe to the channel. Subscribing to the channel will make sure you get a notification. Hit that notification bell. Make sure you get the notification whenever I go live or whenever I release any other content. And also, please join the Discord. The pinned comment in the chat below, as well as in the description below. Join the Discord to be part of our daily discussions of what's going on in markets, what we have going on in our own portfolio, major actions of major investors, and other stuff like that. So come be part of the discussion there. So DHI, DR Horton Homes, here we are. Current treasury selling for about 3.84%. Mature market equity risk premium I currently have is 5.69%. I come up to a discount rate for DHI after adjusting for company specific risks of 11.86%. Pretty solid discount rate there. Cash dividend is currently about 1.14%. 5 years ago, they had sales of about $14 billion compared to the most recent year, about $33 billion. That's sales growth of almost 19% per year for the last 5 years. Pretty dramatic sales growth there. Sales capital ratio, they currently have a sales capital ratio on average of about 1.43 for the last 3 years on average, compared to their industry of about 148. Returns on invested capital about 13.5% currently for the last few years on average, and they currently have a debt to equity ratio of about 20%. Default rate in the most recent year was less than 1%, pretty negligible. Profit margins, they have about 17.5% in the most recent year. As we discussed, though, a huge outlier of a profit margin, definitely going to be reverting to some sort of mean there. And then, in fact, in the 8-year mean of their industry for profit margins being about 8% or so. So you can see the huge disbursement there. Profit in the most recent year is $5.8 billion, and they're currently selling for $87.77 per share. The probability distribution that I'm using for the company is pretty heavily tilted towards the more optimistic model, with 25% weighted towards it, more towards the 15% in the more pessimistic model. And that gets us a sales distribution of anywhere from 27.1 billion in the worst case scenario to possibly 47.9 billion in the best case scenario. On expected basis, I see 37.6 billion, and that equates to sales growth of anywhere from -4% to possibly positive 7.5%. On expected basis, we see about 2.5% per year. Sales capital ratio on unexpected basis, we see about $1.37 in sales for each dollar of capital invested in the business, and we get returns on invested capital of about 11.5%, which, if you remember, the cost of capital was about 10%, so it shows that they will in fact still be earning returns above their cost of capital, which is good. Debt to equity ratio, we see an expected basis about 33%, which I gave my explanation for. As partially comes from the market cap adjustment, but also I do think that they will have to take on more debt in order to continue to operate the business the way that they have been operating it. Default risk, however, I do effectively, even with the increase in debt, see a pretty negligible amounts of default risk, less than 1% per year. Profit margins, I have a distribution of anywhere from 2% to 13%. On expected basis, we see 8.3%. And I have profit distribution of anywhere from 544 million to possibly $6.2 billion. On expected basis, we see $3.1 billion. And that gets us a present value expected price of $74.33 after adjusting for the discount rate across all the expected cases, which is 15% higher than the current share price. We have 5-year forward value targets unadjusted for the dividends that they'll pay out during the time frame of anywhere from $40.52 per share to $262.71 per share. On expected basis, we see $130.17. And comparing that to the current share price, that gets us an implied return of 8.2% per year for the next 5 years. So pretty interesting valuation. Like I said, I was pretty excited to get into it and to do all the work there with the revenue projections and really breaking it down by the segments. But that doesn't mean that we find a company worth investing in here. Definitely still a bit expensive for my taste. A very well run company, well managed, seems to have a pretty good operation within the space, but it definitely needs to be 15% cheaper at a minimum, in my opinion. But so that's going to do it for our valuation here today. Not much more I'm going to say before necessarily signing off here. I'm not sure what all is going to go into the poll for the next stream, but do try to catch the poll. I'll release that probably tomorrow afternoon with 4 companies that people can vote on for what will be in the next valuation. Some of the contenders that were on it in the most recent poll, Ingles Markets is definitely up there on ones I want to value at some point in the near future. Hanes Brands I had thrown up there. There's also Sally Beauty, could be a few others at some point in the future. Jeff, thank you, Jeff. I hope you enjoyed. I'll catch you all again next time. All right, bye.